Inflation is always and everywhere a monetary phenomenon. How much money in the system will give you the general price level, and whether it goes up, whether it goes down, where it is. But there's a lot of movement within the general level, and then that comes back to the tariff thing. You might get, by the way, a little one-time pop in the general price level due to these relative price adjustments, because prices are sticky and you might get a little pop up, but then it'll start trending down again. But the price increase that you see on these particular imported products, that is not inflation. That is a relative price increase of those items relative to other things in the overall economy. Let me give you an example of how this works. So in the 1970s, we had the two oil shocks in 1973 and 1979. And Japan imports all of its oil, and the price of oil goes way up. That would be equivalent of imposing a tariff on oil imports in Japan. And the Bank of Japan in 1973 said, well, we'll accommodate that price increase in crude so it doesn't hurt everybody as much. And they goosed the money supply. And what happened? You had inflation went up. And everybody in Japan says, oh, we have inflation because the price of oil went up. No, you had inflation because the Bank of Japan decided that they were going to let the money supply go up to accommodate the price of oil going up relative to everything else. Then 1979 came and the Bank of Japan learned their lesson. The price of oil went up, but the Bank of Japan did not goose the money supply. And what happened? Inflation didn't go up. The price of oil went up relative to everything else being bought in Japan, but the price of all other goods and services tend to be muted or went down. And the overall price index as a result in Japan stayed, more or less the same as it was before the price increase in oil. So you had two different monetary responses. Let's assume that you're selling me something and you're in some foreign country and you sell it to me for the price and on the terms that we agree to. And that means if you're willing to sell it, you benefit. There's a benefit. And if I buy it, I also benefit. So the seller and the buyer benefit, and something is generated that economists call gains from trade. Trade wouldn't occur if there weren't gains from it. So they're gains. Now, what's the tariff do? The tariff is a sales tax that goes into those gains and sucks part of them out and puts them in the U.S. Treasury. Now, at the margin, and everything in economics happens at the margin, there'll be a lot of transactions where the gains from trade are not as great as the tariff tax that's being imposed on those transactions. And in those cases, the transactions won't occur. There are no possible net gains from trade if the tax you're imposing is greater than the before tax net gain from trade that was anticipated. That's to explain why economic activity and trade will go down. Taxes make things go down, not up. Taxes don't stimulate things, they crush things. Well, they're not seeing the same things. They don't even look at the money supply. I'm looking at the money supply. My point is that he'll be talking about a lot of data. So he'll talk a lot about economic data and then reach a conclusion about where the one thing the Fed pays attention to besides economic and financial data are the Fed funds rate. That's what you were talking about, the interest rate Fed said. So then he'll jump to that. That's the wrong way to go. Monetary policy is not about interest rates. It's about changes in the money supply. He should be talking about the fact that the money supply is growing too slowly and ways to allow it to increase at a little bit faster rate. So he should be talking about taking quantitative tightening off. They're still tightening, reducing the size of the balance sheet at the Fed. That's one thing. He should also be pushing ahead for actually something they're pushing for, and that's to take these supplemental liquidity requirements off commercial banks, because those liquidity requirements require banks to reserve on safe assets like treasury bonds the same way they reserve for risky assets. So as a result, it would give the banks more capacity to make good loans, right? Just economic activity would increase. The velocity would stay the same. So, and I'll use just two examples in the United States. to illustrate why interest rates are irrelevant. And here's why. Let's go to the great financial crisis. Let's take two huge episodes where interest rates, everybody focused on interest rates, just got it all wrong. One is after the great financial crisis. If we look at the U.S. between 2010 and 2019, the Fed lowered the Fed funds rate to 0.25%, and they left it there. They also engaged in 3 episodes of quantitative easing. And so everybody, traditionally, they said, oh, easy money. Some people were even saying we're going to have a hyperinflation. Wrong. The money supply grew at very close to Hanke's golden growth rate, consistent with the 2%. It grew between 2010 and 2019 at 5.8%. And where did inflation grow over that period? 1.8% per year. So the people focused on the interest rate just got it all wrong. We had monetary policy that ended up being more or less right on the dot. Now, what happened with the pandemic, we had a different situation. We had, again, 2020, 2024. Fed funds were pushed down to 0.25% again. And we had large-scale quantitative easing. And everybody looking at that said, oh, we're not going to have inflation. They said, oh, we're going to have just what we had after the great financial crisis. We had very low Fed funds rate. We had all these 3 quantitative easings. And God, we didn't have any inflation. Same thing's going to happen this time. And people like Greenwood and I said, no. This time, the money supply shot up, and it averaged over that period of time 17.3% per year between March 2020 and March 2022. As a result, we had what you said. The inflation did what? It went up to 9.1% in June of 2022 and averaged over that whole period 7%. So the monetarists got it right, and the people focused on interest rates like Powell and every one of those central bankers, by the way, that is what they will be talking about. Whether they're going to increase or decrease their base rates, every single one of them will end up talking about that. And by the way, that's what Trump and Powell are quibbling about. Powell is holding steady, and Trump wants to have a 3 percentage point reduction in Fed funds rate. But their philosophy and their view of things is the same, and it's wrong. I'd say, in a way, their fight is kind of ridiculous. And in another way, ironically, Trump actually has a point. He's basically saying they're too tight. But he should be embracing the quantity theory of money. Say, you're too tight. The money supply is growing below Hanke's golden growth rate of 6%. Rather than fooling around with all this battle over the Fed funds rate, trying to fire governors of the central bank and all the rest of it. I think the overriding likelihood is that the air is going to start coming out of the stock market bubble. You're giving a rosy scenario. You're kind of in a relief rally mode. You say, oh, God, the tariffs, they could have been a hell of a lot worse than they are now. Now we know what they are. They might be terrible, but we know. And isn't that wonderful? Let's have a big relief rally. That's basically what's going on Wall Street right now. And I think eventually people on Wall Street are going to wake up, and they're not going to be smelling the roses. They're going to be smelling something else. That's where we're going. I think real yields will go up. By the way, we've been living in a world for quite some, since the great financial crisis, where real yields were abnormally low and unsustainable. Now I think they're reverting back to the mean, kind of. So even forgetting Trump or anything else, if you just revert back to the mean, we got a ways to go. I think the huge bull market bond is over. If you look, by the way, at the trend line from the start of the bull market in bonds, a 10 years yielding 4.33 right now. And where it should be on the trend line is like about 2.7 or 2.8. So it's broken out completely. I mean, the bull market is just completely gone. At 30,000 feet, I don't really see that many bright spots. And the bright spots, you got stocks like Palantir and stuff like that. The Economist has a great article on Palantir, and the article is the most overvalued stock in the world. They have a bunch of comparative statistics, and it's pretty pricey. They say it's much greater than Cisco was before the 2001 crash. Look what I said about Ukraine. A lot of people think things are going to be settled, and I don't think they will be settled. And I think Russia, by the way, has won the war, and the Russian meat grinder will just continue grinding. That's why Putin has no interest in a ceasefire whatsoever. Right. He has a big interest in a permanent peace, by the way. I think what they should do is do what happened in 1955 when Austria became neutral. The peace, the neutrality, how was that maintained in Austria? The Soviets had a seat at the table. The Brits did, the French did, and the Americans did. And they kept it neutral. It worked perfectly. So that's what they should do in Ukraine. The problem is the Europeans and the United States are having a hell of a time coming to reality and realizing we lost the war. Forget reading the propaganda in the American papers, the Wall Street Journal, the New York Times, you name it. Forget it. It's over. Well, I think the one point that I made earlier on, don't get yourself all worked up and excited and decide you're going to jump out and get spooked out of the stock market. Don't do that, because you're eventually going to have to make another key decision, and that's when to get back in. So you might have your timing wrong on getting out, and you might also end up having your timing wrong on getting back in, which is typical, by the way. So be careful. And the main thing we talked about is rebalance the portfolio, make certain you've got the thing balanced out in a reasonable way, and buckle up your seatbelt.